welcome to this live edition of Capital Ideas TV. Mark's got to remember to turn his audio down. Okay, here we go. We have Bruce Campbell as our special guest today. He's the founder and portfolio manager at Stone Castle Investment Management. He manages the best performing small to mid cap mutual fund this year so far. Now, Bruce has 6 top ideas for you today. He'll also talk about his investing style and give you his small cap checklist on what to look for in small to mid cap stocks. Bruce will be taking your questions as well, and we will be getting to many of you who are already in the chat on our YouTube channel. We're seeing a fair amount of activity there already. Now, before we get to Bruce, we want to remind you that Capital Ideas produces a free daily morning note that you can receive to your inbox to get you ready for your investing day. We also produce the weekly Capital Ideas Digest, where we curate investment ideas based on the research we pay for to arm you with the information you need to amplify your returns. Now on to Bruce Campbell. First up, his bio board. Bruce is the founder and portfolio manager of Stone Castle Investment Management. He manages the Purpose Canadian Equity Growth Fund. He has his CFA designation, and he's a chartered alternative investment analyst. He's a regular guest on Capital Ideas TV and BNN Bloomberg. He also runs the Stone Castle Cannabis Growth Fund, and a few of the picks that he has today are from within that fund. So we welcome Bruce, who's in Kelowna. How are you, sir?
I'm doing well, Mark. Exciting to be here on this new medium.
That's right. It's a whole new world. We're live streaming on the internet. How about that? Free and easy. Off we go. So your Purpose Canadian Equity Growth Fund is up nearly 14% this year. That outstrips your peers, and we're only 6 weeks into the year. It's early days, of course, a small sample size, but how are you achieving that so far?
Well, a couple of things that we do with our portfolio is we run fairly concentrated portfolios. So if you look at our position sizing, we're not diversified amongst, 100 or 200 different positions. We have, fairly meaningful positions. So we like to hold somewhere around 40 positions in this portfolio. So around a 2.5% weight in each one. So each one's fairly impactful. And then the second thing is we have the ability to really go anywhere with the portfolio. So we're not constrained by having to be in a sector. So if we don't see any relative strength in a sector, or we don't see any earnings momentum in a sector, then we tend to avoid it, and we can have that down to really zero if we want, or we can dial it down so that we're significantly below any of the benchmarks. And so as a result, we can really have exposure to where we see earnings growth and drive things from there. Those are probably two of the biggest factors that we look at that drive it. And the third would be just the companies that we look at. So we're specifically trying to target companies that have some type of change in their fundamentals so that they're seeing an acceleration in their earnings growth. And so as a result, we tend to find companies ahead of a lot of other people, and then as a result, we're seeing that real fast earnings growth trajectory where they're accelerating, and it's not sort of your old stodgy company that ends up in a lot of portfolios.
All right, Bruce, I'm just looking at the chat here. We have Sarb Singh, who's got a question for you. We'll get to that a little bit later. We have Robert Solnick is in there, David Sinclair, who sent some questions before in the chat as well. So this Purpose Fund that you're running and that you've been describing, you have a Class A version and a Class F version. So what are the differences, and what are the similarities, and what are the management expense ratios?
Yeah, so the difference between the two classes of the fund are really the trailer that gets paid out to the investment advisors. So if an investment advisor sells us on a front basis, it's the A class, and they get paid a 1% trailer fee. If they sell it on an F class, then they don't get that. They have to charge either through a fee-based account or some other way for the clients that are invested there. So the management fee on the A class is 2.5%, and the management fee on the F class is 1.5%. And so the difference obviously is that 1%. The portfolio is identical. It's just an accounting difference that makes up which units you end up with, and you still own the exact same portfolio, and it's just a fraction, either A class or F class, and then obviously the accountants charge differently for those different classes.
Bruce, let's look at the small cap and small to mid cap universe as a whole, and where it fits compared to other equity types compared to other asset classes. How do you view it, and how do you think small caps can fit into an investor's portfolio?
Well, obviously the big thing is that the money that flows in and out of small cap tends to be, for the most part, higher risk money, and so it'll flow into those sector and flow out of the sector much more rapidly than it does in other places. Whereas if you're holding, a Canadian bank stock that pays a dividend, you're probably fine holding it if you think the market's going to drop 10 or 15 or 20%. If you own a small cap company and you're concerned that the economy is going to go into some type of recession, you probably want to be out of it because their business could dry up significantly. They might have problems raising equity, and so as a result, when things are good in small cap and mid cap areas, the returns tend to be fairly high. But when things are bad, you also can have negative returns that are significantly bigger than sort of the broad indexes. And that is, obviously one of the challenges and one of the things that most investors have to balance off is how much small cap, mid cap they have in their portfolio. The returns are higher over time, but the volatility is greater. So if you have, a longer time frame between, when you need your money and where you are today, then you're going to get higher returns out of a small cap, but it's also going to be more volatile. So you really have to balance that as an individual investor.
And you touched on it a bit, but you need to be nimble, I'm assuming.
Yeah, we try to be fairly nimble with our portfolios. We're fairly active both, as stocks are moving upwards. We like to keep our position weight fairly in check. And so as a result, we tend to be fairly active trimming our portfolio because one of the things that we've discovered is that, things can change quite rapidly in our universe where, a company is doing quite well. Either the stock price is doing well or the company's doing well or both. And that can change quite quickly. And then on the downside, obviously, we want to be quite nimble as well, because when the tide does tend to go out on some of these companies, they can really drop and drop a long ways, especially if they're kind of in that pre-earning stage where they just have revenue, or in some cases where they just have sort of minor revenue as they're ramping up. It can have a fairly significant impact on the share price.
Now we're going to get to your six top picks that you've brought for us today, and some viewer questions as well. First up, though, tell us about the criteria that you look for when you're looking at a small cap. What are the key factors that you absolutely have to see in order to feel comfortable investing in a company?
Yeah, I mean, we look at a number of different things. Obviously, management, especially in a smaller company, is important. And what we tend to look for is management that have some type of expertise and have some sort of track record in the past. So if they've been successful and they've been able to, monetize investments or, sell successful companies in the past, that's obviously a huge check mark that we look for. And then the second thing is how much those individual managers are invested in the business. So, are they just strictly there to get a salary, or do they have, kind of all their life savings invested in it? We tend to find that, the guys that have all their life savings and have written hard checks and have hard dollars into companies tend to, work harder and sort of battle through in a much more persistent way than they would if they were, just strictly getting a salary. And then sort of looking beyond that, obviously we want a company that has some type of specialty, or in a lot of cases people talk about proprietary information, research, process, something that makes them unique, that makes it difficult for their competitors to challenge them, or gives them a head start on their competitors. And then, typically we want to see, with the companies that we look at, we want to see, a vision for being cash flow earnings positive within a fairly short period of time. And that short period of time will vary depending on the situation, because one thing that we found is that, typically if management tells you that they're going to be cash flow positive in 6 months, it's probably, 9 or 12 months. But we want to see that in a reasonable amount of time, because we know that, earnings really drive these stock prices and valuations over the sort of mid to longer term. And so we want to see that ramp up happening. We also like to look at the capitalization of companies, and this sort of goes back to the first point when we were talking about management, and that capitalization is important because what we see is a lot of, get rich quick schemes. And so we tend to do, a pretty quick screen of companies. If, management shows up to our office and they say, oh yeah, we started this thing 6 months ago and we gave ourselves all, free shares, then, typically we don't want to be involved in that. We want to see guys that have written checks and, probably have some type of battle that they've put on for a while to get to where we now are even aware of the company. Sort of the new fresh startups are really hard to invest in. And then, the last thing that we like to look at is we also track, technicals, because what we found is that as much homework as we do with our research, we still know that in a lot of cases, there's information that gets out there in the market, either from non-public material information, or either from analysts or investors doing their homework and digging a little bit deeper and finding information, and that tends to drift into the market. And so, we want to watch the technicals both on the upside and the downside to know when to exit and to enter into position.
Okay, great stuff, Bruce. Great information there. And with that as the backdrop, let's get to your 6 top picks. We're going to sprinkle them throughout the show. We'll probably go about 35, 45 minutes today. So we'll start out with the Viamed Healthcare. This is the company that we featured in May in our Capital Ideas Digest, May of 2018, based on some Beacon Securities research in which Beacon initiated coverage. The stock has done very well. Beacon has a target of $9.50 on it, which gives it about 55% upside. So tell us about Viamed Healthcare and why you like it.
Yeah, so if you look at Viamed, there was a company called, if you go back in history, called Patient Home Monitoring. Patient Home Monitoring has since split up into 2 companies. Viamed is one of those companies, and it was one of the bigger acquisitions that was made back when they were still Patient Home Monitoring. And so the business that Viamed is in is they're actually in the sort of oxygen business for people that have different type of respiratory problems. And so effectively what they do is they provide ventilators to people who in a lot of cases are fairly sick, and what they're able to do is come in individually with those people, work with them, so they show them exactly how to use the ventilators, and then they rent those ventilators and all the supplies that they need for that person. And what they're really trying to avoid is any type of hospital readmission. And this is sort of, if we talk about kind of their sweet sauce, is a sweet spot in their secret sauce, this is what it is for Viamed, is that, there's other companies and other competitors out there, but typically they just sort of like give these people the ventilators and send them home from the hospital. And what they found is that these people tend to get readmitted back into the hospital. Whereas Viamed, they have technologists that work specifically with those individual patients to show them and help them so that they continue to use the product properly, and so that their health actually stabilizes and improves and they don't end up with those hospital readmissions. And so as a result, the Viamed tends to be, in the areas that they operate, tends to be the operator that the healthcare providers want to go with, because they know that they're not going to get any type of readmissions, and they get charged if they get readmissions. And so they really focus on sending those people to Viamed because their service is so much better. Now, what Viamed's doing is they've obviously started, in one geographic region. They just continue to expand out. So if you look at their growth, it's been tremendous. They, if you look just strictly at their revenue numbers actually, been stable and growing. It pulled back, but that was because there was actually a Medicaid and Medicare cut in the amount of reimbursement that they get for these. At the same time, they were able to increase enough of their organic growth with their patients that they basically kept year over year their revenue line almost flat. And now that cut's behind them, they can obviously go and continue to grow and increase their revenue. And they're also very profitable for the business segment that they're in. And so we think there's tons of room for them to continue to grow as they expand into other geographic regions.
All right, a nice detailed answer there on Viamed Healthcare, one of the top picks that Bruce has for you today. Another one is Valens GrowWorks. This is a company that Capital Ideas has done some marketing services for. Tyler Robson is the CEO. We had him here on October 17th, the day, naturally, or of course, that Canada legalized recreational marijuana. He has a science background. This is a company that specializes in extraction. You've got Haywood Securities with the coverage on Valens. It's got a buy rating, a 525 target, gives the upside of nearly 100% or so, roughly. So tell us about Valens GrowWorks and why it stands out for you in terms of extraction, because a lot of companies are in this area.
Yeah, so if you look at sort of the evolution of the cannabis sector, if you go back 3 years ago, everybody was really focused on cultivation, the cultivation facilities, and the amount of size of those cultivation facilities, and what that meant was how much they could actually produce from a pure kilograms of product standpoint. The next evolution, and we'll see several of these evolutions in the cannabis sector over time. The next evolution is, and specifically in Canada, is moving towards these extracted products. So what the companies are doing is, they're taking the actual raw cannabis and they're running it through an extraction process, which pulls out all the oils and all the different cannabinoids out of the plant, and then they're able to use those in different products. So obviously, the one that kind of most people know about is edibles. The beverages is another segment, and then obviously the vape pens is quite big. Those are all segments that are big in the U.S. They're not going to be big in Canada until the legislation gets put into place, which we've been told is going to be, the latest will be October 17, 2019, and it's probably going to be rolled out in stages. So there's possibly going to be vape pens first, and then some edibles, and then beverages. We're not really sure because the government's still finalizing all that. But what Valens does is they actually do that extraction work. And it might sound like it's quite easy at first, like, oh, you just, throw some cannabis into one of these machines and you extract it out. Well, there's lots of fine tuning that needs to be done in order to get the kind of recipe exactly right and to not destroy the good or the flavor or, different aspects of that. Tyler and his team have tons of experience doing this, both from being in California and watching what happens down there, where they're really the experts in this area, to operating in Canada under the MMAR. They know this better than anyone else. What they've done is they really focused on extraction, and so they've built a facility that has the ability to just continue to add extraction capabilities. And what they're finding now is that many of the large LPs have some extraction facilities, but they're not able to get the quality or get the quantity done that they need. And so then they're going out to companies like Valens and contracting them to do some extraction. And then all the mid-tier and smaller players, they just don't have the technology or the expertise or the money to be getting into extraction, and so they're contracting out. So what you've seen, in the last sort of 3 or 4 months now, that since Valens got their processing licenses, have you seen them, constantly adding LPs to their list of contracts as far as who they're extracting for? And the first one is they were part of the Canopy Craft Grow program, and so we know that they're going to be doing some extraction work for Canopy. They've announced Organogram. They've announced another fairly significant contract, but we don't know exactly who that is. They've also announced that they're increasing their capacity. So this will end up being a fairly significant cash flow machine, as they, all that they're really doing is taking the cannabis in, turning it into oil and different products, and then selling it back to the LPs, or getting paid a fee to process it for the LPs. And this is where where their future really will be. Bruce Linton likes to talk about his target market being the 40-year-old mother who comes home at the end of the day, and instead of having a glass of wine, she's going to have some type of cannabis product, be that something edible, something a patch, whatever that is. All those different delivery systems and different delivery methods are going to require extraction. And this is where, the market's going. In the US right now, over 50% of the market is in the extracted product, and that continues to increase to the detriment of the dried flower and pre-rolls. So we like Valence because we think there's huge opportunity for cash flow as they sort of fill the pipeline of all the processing capacity that they have.
And just quickly and lastly here with Valence, you mentioned that they recently announced, I believe it was today, that their capacity is going to be larger now. Am I right in saying 240,000 kilograms? Is that correct?
That's correct. Yeah, that was just announced yesterday. Or last
okay.
night, I guess. Yeah.
All right. So a couple of top picks so far from Bruce. We've got Viamed Healthcare and Valence GrowWorks. And now we'll get to some viewer questions. David Sinclair, he wrote in and he wants to know about C21 Investments, which is also in the cannabis space, kind of a holding company. Bruce can speak to it better, but one of their investments is in Nevada. So C21, I know it's something that it's a company you've talked about before.
Yeah, it sure is. Yeah. So right now, the wave in the U.S. in cannabis is these multi-state operators or branded companies. There's sort of two areas that investors are really focused on. The multi-state operators are obviously people who have gone in and have an operation in one state. They get a license in a second state, and they're able to kind of share their technology and their brands between states. They can't take any cannabis between state lines. And what C21 is doing is they're in the process of trying to do that via acquisition. So they've got some assets in Oregon right now. The big asset that they just bought and they closed at the beginning of this year is the cultivation facility and the dispensary that's in Reno. It's actually in Sparks, which is a suburb of Reno, and it has tremendous cash flow. And they've just recently opened a second dispensary, which is in Fernley, which is interestingly enough where Tesla is going to have one of their big facilities. It's a city that doesn't have any dispensary right now, and C21 has just opened that as well. So if you take a look at the valuation that C21 has, it's fairly cheap compared to most of the other multi-state operators. And what I suspect you'll see over time is that they'll continue to, add on new geographic regions or new cities, and both expand from an organic standpoint, but also from an acquisition standpoint. And that's really why they've built the vehicle they have, is so that they'll have a currency to go out and make purchases. And if you look at the most recent purchase of Silver State Relief, which is the operation in Reno and Fernley, they did that, and the person that was selling that took a great deal of stock in C21 because obviously they see the upside in the stock price, and also wanted to be able to still work actively with C21. And I suspect that's the kind of deal that you see them doing going forward.
All right, another question from David Sinclair is on Indiva. This is a company we interviewed several months ago. We had the CEO in here. Update us on this story.
Yeah, so Indiva, they've been probably a little bit slower than we would have expected. We've owned the stock for a while now, and they have some pretty interesting products. Or I guess not products, but they have the recipes and the formulas for products that are in the U.S. that are fairly significant. So where I think you'll really start to see a big ramp up in this company is once the extracted products all are released, they're going to automatically have formulas and they're going to have brands that are successful down in the U.S. and they can bring those to Canada. So if you think about just the advertising perspective, Canada's not able to advertise, or they're not able to really advertise in any capacity. It's very similar to tobacco, but in the U.S. that's not the case. And so any advertising that is done down in the U.S. will automatically cross over into Canada. Interestingly enough, Indiva just recently signed a supply contract as well with one of the provinces. So that's great news that they're now starting to get enough supply that they're able to supply these provinces with product. And so that obviously starts to build their retail following, so that when things really do change in in October with the extracted products, they obviously have people that know them and are familiar with the products, and it'll just be probably a transition from the dried flower to the extracted products.
All right, very good, Bruce. We'll get back to some viewer questions. We'll get back to your top picks in a moment. We're going to shift gears here briefly. We've got a bonus idea for you. A Capital Ideas contributor, Fabrice Taylor, was on our show recently, and one of the stocks he recommended back in 2011 for a couple of years surged more than 1,100%. This was one of the first stocks he ever recommended in his investment newsletter, the President's Club. And Fabrice now thinks that Athabasca Minerals is set up again for some big gains. He's the largest shareholder. Here's why he likes it.
It's the third stock I ever recommended in my newsletter at 25 cents, and it went to $3 in about, I think, 3 years or 4 years. They have a frac sand deposit, and it's permitted, it's large, I've been there myself, and it's ready to go. And you probably know that Shell Canada, or Shell, has green-lighted their LNG plant. Everything is tickety-boo. There's a little bit of protest going on right now, but the government's on side. The native bands are officially on side. Justin Trudeau needs this deal. He needs it. He's bragging about it because everyone said you destroyed our industry. And now he's running around saying, no, I didn't. Look, this is the biggest single investment project ever in Canada, which is true. It's $40 billion. Now, it's going to happen. Okay, and no one believes it anymore because of all the negative things that have happened, Trans Mountain and all the other pipeline problems. There is a pipeline here. This is gas. It's a lot greener than oil. It's not heavy oil. But think about all the frac sand they're going to need up in that area, in the Montney. It's millions of tons of it. We have a frac sand deposit, Athabasca Minerals, of which I'm one of the biggest shareholders now. It's been appraised at $30 million. They have $5.5 million in the bank cash. The market cap is 13. So there's going to be huge demand for frac sand up there.
Kintavar is a unique exploration company that looks at undervalued and underexplored projects and converts them into what today is a Michi stratiform copper project, a unique stratiform copper project in Quebec. It's the only primary copper exploration project in Quebec. Strong support from the local community, great access to infrastructure, great location, camp, power, everything is accessible. And we had a great year in 2018 demonstrating the size of the project, and we expect 2019 to be even a better year than what we had in 2018.
We are back with Bruce Campbell, the manager of the Purpose Canadian Equity Growth Fund. He's got 3 more top picks for you, and he's taking your questions as well. Actually, four more picks coming. Here's one of them right now. Let's get back to Bruce. Beware Holdings. This is an Internet of Things. A company, ticker is BEW. You've talked about this before. They sound very interesting. Tell us about Beware.
So what Beware has is they have basically an asset tracking device that allows people to track pretty much anything that they want. And they originally started with a Bluetooth version of this, so it had to be connected to a Bluetooth device. And now the latest iteration that they've come up with is it's a low power, wide area network. So effectively, what you're able to do is connect to the internet or connect to a wireless network through cell phones. So this is, if you think about what the cell phone companies have done, they've sold us all one cell phone, and we all have plans, and we pay monthly for those things. But now that they've kind of saturated the market, where do they go next? Well, what they've discovered is that if they can start charging people to track different assets, then they can increase their revenue and have more of us paying for stuff. So just as an example, sort of the industrial applications of this is, if they want to put this on a trailer, that they want to be able to track and see where it goes, kind of around the country. They can track it on the inside. They can see temperature. They can see vibration. They can see speed. Things like that. If you own a construction company and you want to make sure that nobody loses the jackhammer or leaves it on the construction site, you can put it on one of those and they can track it. They've had quite a while bringing the product up and testing it, because this testing takes a lot of time with the different cellular networks. They want to make sure that when they roll something out, it's absolutely rock solid, works. And they've done that all now. They've got a couple of bigger carriers in Canada, both in Canada and the US, that have come on board. They just recently did an equity raise, which they when they described sort of the purpose of the equity raise was to be able to buy hardware, because it, they have so many orders coming, and obviously there's a a 90-day probably receivables cycle that they'd have to deal with. But in the meantime, they would need to be able to stock all these orders. So they raised some money for that. And we think that, after waiting for probably about 18 months or 2 years now, they're probably getting very close to the trajectory where, the stock's going to really move, and you'll see, Bell in Canada and, probably the bigger networks down the US starting to sell this product, and they're going to, take it on, and all their salespeople are going to go out there and show it to different customers for a number of different applications.
All right, so that is Beware Holdings. That is another top pick of Bruce Campbell. Let's move along to another one. Cannabis Capital. We had the CEO, Anthony Dutton, in here several months ago. We've done some marketing services for this company. Paul Beatty, who is the head of BT Global Growth out of Montreal, this is one of his top holdings. He's got a U.S. cannabis theme this year among some of his themes and trends, and he really likes Cannex too. So fill us in on Cannex, because I know they had a deal in place in the U.S., I believe, and then that seemed to fall apart, but then they struck another deal, which may be even better and more advantageous. So bring us up to date on Cannex, please.
Yeah, so Cannex originally started by buying an operation in Washington State. And if you look, there's actually public data on this. Washington State publishes each month the amount of sales that they have broken down by product category, by company, all of this. And Cannex, through their Northwest Cannabis, continues to rank very high in that sales data every single month. That was the original purchase that they made, and then they wanted to expand out, and they were going to go into California, and so they announced a deal down in California. And the market doesn't necessarily love this, but I always love it when a management team backs away from a deal. And that's exactly what they did. Is they went down into California, they started doing their due diligence, and obviously either the terms weren't right or they got spooked by something they saw, and they backed away. And the market, of course, was disappointed with this. They were looking forward to having this acquisition done, and so the stock price pulled back. In the meantime, the team was out there looking for other opportunities, and they came across this opportunity with Forefront. And Forefront is a cultivator in sort of the Midwest and eastern part of the U.S. They have real focus on the West Coast with Northwest Cannabis out of Washington, and the two are going to combine. And at the same time, they also got a huge cash injection by equity investment from Gotham Green. And so you sort of combine that all together, and once this deal closes, which the market's probably not really paying up for it yet, because they probably look at it and say, oh well, Cannex had trouble closing before, which I don't really think they had trouble closing. They chose not to close it. But once they close this deal, then I think the stock gets revalued and goes significantly higher. Because again, if you sort of look at it from the multi-state operator perspective, it's fairly cheap compared to most of the multi-state operators that are out there now from a valuation perspective. And once they do this, they'll probably bring their expertise from the West Coast to the East Coast and vice versa. And so they're going to get a lot of efficiencies, and then they probably also open themselves up to make more acquisitions.
All right, some more viewer questions now, and that was Cannex Capital, another top pick. We've got 4 now, 2 more to go from Bruce Campbell. So some viewer questions. We had Brock Payon, who's in the chat, asking about Tinley Beverage Company, TNY.
Yeah, so I haven't caught up with Tinley for a while, but effectively what they're working on is they're working on cannabis beverages that look a lot like alcoholic beverages, specifically for the California market. So obviously the California market is way more advanced than really any other market in the world. It's been legal there from a medical standpoint for a long time, and now it's legal from a recreational standpoint as well. But Tinley was working on developing different types of beverages from a standpoint of, it looks like and tastes like rum, or looks like and tastes like, scotch or something like that. And then they were also targeting some of the, energy drink market as well. So again, it's, one of those verticals that as the user base kind of broadens out and gets more diversified, a company like Tinley could do very well. That being said, I haven't really done an update with them lately to see where exactly they have progressed in probably about the last 4 or 5 months.
All right, fair enough. A couple of questions here on TGIF. That's the ticker. That's what the name of the company used to be, and they've changed the name since to 1933 Industries. But this is Robert Solnick. Could you ask Bruce why TGIF does not receive the same forward-thinking mentality from the market that other companies receive, i.e. a low valuation multiple? Do you think that's true? And if so, how come?
Yeah, I'm. We own 1933 in our portfolio, and I am a little bit surprised that it hasn't received better valuation than it is right now. If you look at 1933, they really have 2 divisions, and both divisions are very good at what they do. So their AMA division was the first license in Las Vegas, and they're really focused on the THC side of things. They've got a number of different products that they build and produce for under license for people out of California. So because again, you can't take marijuana across the line, across any state lines. If you have it in one geographic region, you have to be able to have it separately produced in different geographic regions. So they do that in Las Vegas and sell specifically into the Las Vegas market. They don't have any dispensary to their business, but they do have the cultivation assets. They're really experts in producing products. They have some products that are crazy high margin. So products that sell for $125 per gram that might cost them $20 or $25 per gram to actually make, and they're products that just sell out immediately. So that's their AMA division, and then they have their infused division, which is the CBD side of things. And the CBD side of things had a huge head start. They've had this company going for about 18 months now. And obviously, the Farm Bill just passed in the U.S., and now everyone's talking about CBD, including Canopy talking about having this hemp operation in New York now. But they're already selling, and they're selling nationwide to different companies. And into different dispensaries. The thing that 1933 is really going to see is they're going to see a huge ramp up probably in the second half of this year as they move into their new buildings. So right now they've been constrained by the amount of marijuana that they can actually grow in their facility. They have a small facility, and then next door they have a sort of mirror image of that facility that they use for AMA. But they're taking that and going from 10,000 square feet to just under 70,000 square feet, which will allow them to have a lot more product. Right now, there's still a huge shortage of any type of product in Nevada. And so if these guys have the ability to grow more, they'll also be able to have the ability to produce more of their products and then sell it as well. So I think that they're going to see a huge ramp up. And then once you start seeing the numbers, I think at that point in time, the street will start to say, okay, yeah, they've been spending money to build this building, get everything up and running. Now, we can see this huge ramp up in the revenue, and it also is going to, fall to the bottom line and be profitable.
All right, very good, Bruce, on that one. Let's move along to another viewer question here. John Scholmeyer, CIBT Education is the one he's asking about. The ticker's MBA. It's setting out to get a dual listing with the Hong Kong Stock Exchange. How does Bruce think this will help with this undervalued stock that he believes you own? You still own this?
We do own it through a convertible, yes. So we still own a piece of it. As far as the valuation goes, I think that you'll see a higher multiple. The one thing with CBIT is Toby Chu and his team have done a phenomenal job increasing the asset value there. So, effectively what they have specialized in is really in real estate projects in the Lower Mainland. So they operate they operate a number of different schools, and those schools really are the feeders for their real estate. And so what they've discovered is that there's this huge shortage of student housing, really any type of rental housing in the lower mainland of BC. And so they've gone out and they've developed projects, they've bought projects and renovated them. And when they've done this, they've been able to increase the value of those projects, and they've also been able to increase their cash flow. The market hasn't really paid up for this I think for a couple of reasons. One is because their numbers tend to be fairly lumpy. While they have continued to increase their cash flow, they've also, they see one-time write-ups of their assets. And so as a result, the market doesn't really know when those are coming or how to value those. But the asset value is significantly higher than where the stock price trades. And what their thought is that they went over to Asia specifically to get listed because they have a lot of their investors who are in Asia. And so this should facilitate trading and volume, and presumably then they'll pay a higher multiple for the stock. And of course, if it's duly listed, it should have an arbitrage between the two. So I know they've been working on this for probably about a year now. They finally announced it, I believe it was last week or early this week. And so we should start to see, as they get closer to that listing, we should start to see if this is going to really play out, and we'll start to see the stock price moving higher and the valuation bump up.
Okay, that's Bruce Campbell on CIBT Education. He's got a couple of more top picks for you. We've got some more viewer questions coming. But a brief change of pace again, and a bonus idea for you. Clean Seed Capital is a company that makes so-called smart seeders for the agricultural sector. It recently made an acquisition in the U.S., and it's close to a financing. Fabrice Taylor, one of our contributors, made it a top pick the last time he was here, and here's why he likes the stock. Another top idea, top pick that you're talking about here is a Clean Seed Capital.
Right, Clean Seed has technology that improves planters and seeders. These are machines that farmers use to plant crops. And they've been around for a while. They've been proving up their technology, and I've talked to some farmers who think it's very promising. But what really turned my head, I've known the story for a few years. I just bought stock last year in the fall for the first time at roughly the price where it is now, maybe 2 cents more. Gary Anderson is one of the co-founders of Ag Growth International, and he and his partners built that into $1 billion business. He's still on the board of Ag Growth, but he's no longer involved. He's now the president of Clean Seed. This is a guy who understands agriculture, obviously, better than you and I ever could. And who's built businesses and succeeded at building capital markets businesses. And he's taken a job, not even as CEO, but as president, the number 2 of. And so I called him and I said, "What are you doing there? What?" And he said, "This is very amazing technology. This is game changing." He's invested over $1 million of his family's money in this. So right now, the technology is ready. They're working on a merger with a manufacturer in the U.S., a private company. And if it happens, then the deal will produce a company that generates tremendous revenue and has manufacturing abilities and skill. We're waiting on financing. We haven't heard yet. They're trying to finance the deal with debt. I'm trusting Gary's connections because he's met a lot of lenders in his life. When that happens, the stock's going to pop. It's cheap right now, but if this deal happens, when it's announced, when it happens, Gary tells me it's not a question of if, it's when. This stock's going to multiply over time. So I like that one a lot too. And again, no one cares because it's not weed.
Ideas TV Live. I'm Mark Bunting. We're with Bruce Campbell, manager of the Purpose Canadian Equity Growth Fund. He's got a couple of more top picks for you, and he's taking your questions as well. Let's get to some of those top picks, and we're looking at Polaris Infrastructure. This is a renewable energy company operating in Latin America, PIF. It's been a pretty good story. Stock, last time I looked, was maybe going sort of sideways. Can you update us here?
Yeah, so if you look at Polaris, they have quite a history, let's put it that way, in that they initially identified this geothermal project in Nicaragua several years ago. They started to work on getting it financed. They didn't raise enough money. the company had to come in and they had to do a restructuring and refinanced it and renamed it Polaris. And so effectively what they do is they go and they drill wells down into the ground into effectively hot water, which then comes up from the surface and runs a turbine, which then generates power. And so as it is right now, they're one of the largest power producers in the country, and they have the ability to continue to increase that production as they drill more wells and tie those wells into their project. The stock has suffered a little bit because of the political unrest that has been going on in Nicaragua. People have been concerned about this, and they worry that maybe the country comes in and takes the asset. We don't feel that that's actually going to be the case. They're happy to have Polaris continue to operate it and to continue to generate constant power for the government. Pays a nice yield. We think that, and they've already announced one project that they're expanding, but we think they continue to expand out and move beyond being a one country, one asset company, and continue to move out and look at renewable power, either through hydroelectric or through geothermal or through wind, and they continue to build up this company. In the meantime, it generates nice cash flow. You get paid a yield, and we think that kind of as more investors warm up to it and realize that the political issues in Nicaragua aren't affecting the stock, or as they add new geographic areas, then the stock price will end up going higher.
All right, and your last top pick among the six, we've had a few questions on this one, Heritage Cannabis. The ticker is CANN. What makes this company different?
Well, this is a fairly new company for us, and we're still kind of in our due diligence process with it. But what became quite apparent and quite interesting with it is that we think it is in kind of the same business, or is transitioning into the same business as Valens is, in that they just recently made an announcement last week that they've acquired 4 of these Q90 Vitalis extraction machines, and that's probably is from a extraction capacity standpoint. That would be certainly in the top 5 of companies in Canada as far as their extraction expertise. That in itself is not enough to buy the stock, but when you marry that with the fact that they have a facility in Ontario and in BC, they have the ability to extract both in central Canada and also on the west coast. And then they also have some people who have expertise in the extraction business. And as I explained with Valens earlier on, it's not so simple as just throwing it into the machine and the machine runs and making it work. User input is very important, and that really comes with trial and error. And their team are people that have been, again, in the MMAR side of the business for years, done extraction on a number of different techniques and with different machines. And they take these Vitalis Q90 machines, which are kind of one of the gold standards in the business, and they, from what I understand, they actually rip them apart and reassemble them in a way that they want to use them to get higher yields and higher quality. And I guess the quality of the product that they produce is really second to none. And so it's one that we're sort of actively doing more due diligence on, but I'm just saying, like, it's one to throw on the radar right now, do some more work, but it could be tremendous upside as they turn themselves into a big contract toll manufacturer similar to what Valens has done. And obviously they would have the cash flow profile that you can see in that research report on Valens.
Okay, we're looking at Polaris here again. Let's see if we can get Heritage Cannabis up. And as we do that, I can tell you that Bruce has given us 6 top picks. Let me summarize and recap them. Viamed Healthcare, VMD, Valens Growworth, VGW. Beware Holding is a top pick, the Internet of Things company. BEW is the ticker there. Canix Capital, CNNX is the ticker on that one. Polaris Infrastructure, we just saw the chart. Bruce talked about it, PIF, and then Heritage Cannabis, CANN, the ticker on that. So we've got one last viewer question. And thank you, by the way, for taking part and asking your questions. If we didn't get to your question on a certain company, it's because Bruce doesn't follow it. But thank you for asking. One of those, for example, actually it doesn't matter. But let's move along to a last viewer question here. This is from Mark Hanna. PTQ, this is a ProTech Home Medical. Is that the correct pronunciation?
That's correct.
Yeah, there we go. Nice chart. Yeah. Go ahead.
Yeah, so PTQ is in a similar business to Viamed in that they're in that healthcare business. They were again part of the old patient home monitoring. This was the sleep aids business that was bought by patient home monitoring. Greg Crawford and his team have done an excellent job of having this business focused on organic growth. They've really focused on bringing their accounts receivable in and increasing their margins. And as a result, the stock trades at around 5.5 times enterprise value to EBITDA, and most of their peers trade, kind of anywhere from 10 to 15 times. So, you can see the stock double or triple and stay in the same range as their peers as far as pricing goes. So it's one that we own and we like. It's one of the positions in our portfolio, and we think that as they continue to execute, the stock price will continue to grow based on multiple expansion and then also earnings growth.
All right, Bruce, we want to thank you so much for all the great information today. You gave us some investing strategies and philosophies as it relates to your involvement with small and mid-cap stocks and the 6 top ideas. So thanks so much. We'll do it again. Yeah,
thanks for having me. I appreciate it. It's lots of fun.
All right, and thank you everybody for taking part in the chat and asking your questions. Now, as we wrap things up, a reminder of the special offer from Capital Ideas. It's a 30-day trial that gives you immediate access to our premium weekly digest. These are the research-based actionable investment ideas that are reserved for our paying subscribers. You'll get access to 4 issues, and you can find out what you're missing. Just go to capitalideasmedia.com/30-day trial/. That is it for this live stream show. Thanks again for taking part. If you missed any part of it, you can watch it on our website or on our Capital Ideas TV YouTube channel. It will sit there and live and breathe. You can watch it anytime. We'll also have a podcast version of this show coming next week. Bye for now, and we'll see you next time.